Mark Schofield is Global Head of Rate Strategy at Citigroup, joins us now from the bank's London offices. Mr. Schofield, thanks very much for speaking to us. So as we were saying there, the main objective here is to lower long-term interest rates. Tell me exactly how is it going to work? How effective is it going to be?
I think the problem with Operation Twist is that it's not QE as we know it. It doesn't actually inject any new money into the economy. The way it's supposed to work is by removing risk from the economy. So the theory is that you take risk out of the private sector and investors replace that with different types of risk. So they buy equity markets, they support risk assets, and that improves financial conditions and boosts confidence. The problem, I think, with Operation Twist is that confidence is very low. The economic backdrop has been very weak. Investors don't really have that confidence, and they have a very steep yield curve. So effectively, as you take duration risk out, all they're doing is replacing that with more of the same. And until the curve really flattens out aggressively, I don't see that investors are going to go anywhere else.
All right, so then how will it impact the level of yields in the immediate term future? You're saying that they need to flatten out aggressively, sharply, in order to boost the appetite for risk, if you like. But right now, is it a good thing or a bad thing for bonds?
I don't think it has a huge impact on the overall level of bonds across the yield curve. I think it's a pivotal shift. Part of the reason for that is that the Fed has, up to now, been taking all of the duration out of the front end of the market. And that's provided an anchor alongside stable Fed funds, which has kept the front end of the curve pinned. If the Fed's not there anymore, investors have to make that decision to buy issuance at very low yields at the front end of the curve. And I don't think that's going to happen. So we probably see yields in the short end of the curve just drifting a little higher as they have overnight and since the announcement, but yields at the long end of the curve moving down. So it's a pivotal shift, probably around the 10-year point.
And nearly 30% of these purchases by the Fed will be in the 20 to 30-year sector. Is that pretty much what you were expecting? Did that come as a surprise to you?
It was what we were expecting. I think it's a little bit longer than the market consensus was expecting, which is why we've had such an aggressive flattening of the curve overnight. But, we feel that there is a need to target yields at the long end. The Fed's holdings of securities at the long end were lighter than they were in the shorter part, around the 10-year part of the curve. So not a great surprise to us, but I do think that the market was anticipating something a little shorter, and that's why the flattening is such a big move.
And what about the size of the program, the magnitude of it, Mark? Perhaps a little less than you were expecting at $400 billion?
I think the key here is really the duration of the program. So 400 is smaller than the QE2 program, but when you look at the size of the duration extension, there's more duration in the Treasury portion. It's offset a little bit by the announcement that maturing MBS paper will not be invested in Treasuries, but rather in the MBS market. So net-net, the DV01 or the duration of the program is not too dissimilar to QE2. So again, it's roughly in line with expectations.
And that did come as a little bit of a surprise, didn't it, to the markets, that it wasn't just about twisting the balance sheet, but also about reinvesting maturing securities into mortgage-backed securities, as you say, rather than treasuries. Is this the right way forward? What did you make of that?
I think it is the right way forward. I do think that it's important. I think the actual act of bringing down long-end treasury yields has very little impact on the real economy. Bringing credit spreads, mortgage rates lower is, I think, a critical part of the policy. The question is the rollover of maturing debt is a relatively small step. Whether the Fed has to take larger steps in that direction remains to be seen.
Just a brief one from you, Mark. There seems to be a broad consensus that the benefits, if you like, will be somewhat limited when it comes to actually getting investors to go into equity markets, as you say, precisely because of the headwinds that are already there. And then, of course, notwithstanding the broader sort of fundamental economic problems that you have right now, are they going to have to go one step further, an all-out QE program?
The key to that really is going to be in how equity markets and risk assets react. The aim is to improve financial conditions, and if that's not happening, then clearly they're going to have to continue down the same path or vary the path and target perhaps more credit-focused securities.
Mark Schofield, Head of Interest Rate Strategy at Citigroup Global Markets, thanks very much.